Hey, you guys, this is Tamiya Robles. I am your credit repair specialist expert. I am the host of my podcast, Coast to Coast Credit. I am the owner of FixMyCreditNow850.com. I am also the president of NAREB's High Desert chapter out here in California. And I have with me today for our weekly how to ask, I'm sorry, nope, I gotta get our title together. Ask a mortgage lender with Sean Rogers, who is also not only a lender, but he is also my second vice president in the chapter. Sean?
Thank you, T, for having me. Yes, we're going to discuss down payment. How much is enough? What do I need? What do I need? All right. So in my previous videos, we went over the requirements for FHA, VA, conventional, USDA, QM. There are some caveats to that. Yes, you have to meet the minimums, but for all intents and purposes, sometimes that may not be enough. So let me break it down and explain so it makes sense. So let's look at this scenario. Let's say you have maybe a 580 credit score, okay? And you need to go FHA. So we're at 580. I'm pretty much right automatically in the FHA bucket. So that's where I'm going to live at, right? In the FHA bucket. Okay. Now, if I'm at 580 even, my requirement is 3.5%. But let's say my credit profile is a little rough, right? Let's say I have some late payments. Let's say I have, as I talked about before, multiple layered risk, right? And based upon my layered risk, I may have some late pays, collections, something happened in the past 24 months. And what I need to do, because I cannot do a manual underwrite, because of those multiple layered risks, I need to get what they call an automated approval. Sometimes the automated underwriter will let me get an approval if I put down another 1.5%. So 5% as opposed to 3.5%. Okay, that may help. Now, let's look at conventional financing. Let's say I'm at a 620 score and my credit's a little shaky, right? Remember, like I said previously, the more skin in the game that you have, right, the better chances are for your qualification. Remember, if I have a lower credit score, if I have a higher debt to income ratio, right, these items are layered risk. It increases the risks of default on the loan based upon statistics and homeowners that came before you. Okay. So to ease that layered risk on conventional financing, I'm going to try to have a lower debt to income ratio or put more money down. Sometimes the 3% may not cut it. I may need 5%. Okay. Sometimes something between 3% up to 5 or 4%, and maybe shortening your term to maybe instead of a 30-year, doing a 25-year mortgage could also help. Okay. Now remember, let's say that you guys came into some money and you are thinking that maybe if I put more money down, I'll have a much lower monthly payment. Okay. Not necessarily. Sometimes that same extra money can go towards buying points to buy down your interest rate, right? Sometimes that extra half of a point difference in rate can be cheaper than you spending 20 or 25 or $30,000 in balance reduction to get a lower monthly payment. Okay. So when you're talking to your loan officer and you're in that scenario, you want to look at, okay, if I spend 2% of my loan amount, basically 1 point is equal to 1% of your total loan amount, not purchase price, loan amount. If I spend 1% of my loan amount, okay, or 2% of my loan amount, that should save me sometimes $100 to $200 a month in the payment, to where it'll take a lot more than that to lower the payments by doing standard principal reduction. So before you decide to put a big chunk down, maybe try putting half of it towards a rate buy down and the other half towards a balance reduction. Okay. And once again, if you do that, this does also help offset your layered risk. Okay. Now remember, if you have even more money than that, then yes, you may want to look at putting more money down to get a certain payment that you want to be at, right? But once again, it varies from person to person. But once again, if you're facing a layered risk scenario, more money down does help the situation for automated approval as opposed to less skin in the game. But in most cases, if you're an average borrower and you have an average score and you're kind of in the middle, right, applying half of those funds towards down payment, maybe the other half or larger half towards your interest rate buy down may end up being better than putting all that money to the principal reduction. Right. I hope that made sense. Right. Also, remember, down payment assistance programs, once again, it does cover, right, the borrower obligation or the borrower requirement, but for all intents and purposes, it is another form of layered risk depending upon exactly where you're at in your credit profile, debt to income ratio, etc. It always helps for pricing, interest rate, payment, if you can put down your own money. As an example, a lot of my DPA programs are sitting at a 7.25%, 7.125, 6.875, where a current 30-year fixed right now is sitting at a 5.875 to 6.1%, right? It's the whole point. You pay for that free money. It can be expensive. Free money can cost you a lot more money on a monthly basis, right? So what I recommend is that you do what you can to save up what you can for as much down as you can put, because long term, it does help you a lot more as opposed to using down payment assistance. And the process usually is a little bit easier and faster to get done because you're not waiting on third parties and whatnot, as opposed to, using DPA, right? All right. I hope that helped you guys understand how your money is allocated when you are putting money down, or how much is required for a down payment, right? If you have any questions, please let us know. We'll get you squared away. T?
Excellent. Thank you. Thank you again, Sean. All this good information. Yeah. I hope you guys are paying attention, taking notes, making sure that you are leaving your comments or at least clicking on the links and connecting with Sean. And this is enough information to help you decide on and encouraging you to go purchase a home. So hopefully you definitely do so. Be sure to like, comment, share, subscribe, join, download all of our social media platforms, our videos. We're everywhere on these streets. But definitely click on the link for Sean, fill out application so he could do a soft pull, give you a plan of action. If you need credit repair services from me, you can schedule a free 30-minute consultation. The link is below. In the meantime, guys, I wish you guys the best of luck on your credit journey. Sean, take us out.
Thank you, T. And yes, once again, click on the link in the bio for a quick free application. Takes about 5 minutes to knock out. Very easy, very simple to walk through online. We do complete a soft pull, so no need for a hard hit or a hard credit inquiry. And we will give you a game plan to get you ready if you're not already ready. Once again, thank you for tuning in, and we'll see you next time.